California's housing market is a study in contrasts, representing both the pinnacle of American real estate influence and its most profound affordability crisis. As the nation's single largest and most influential market, the state is home to nearly 15% of all U.S. residential property value, meaning its trends have an outsized impact on the national economy. However, this dominance comes at a steep price. The statewide median home price hovers around $850,000, a figure that is more than double the national average and places homeownership firmly out of reach for a significant majority of its residents. This sustained unaffordability is not driven by price alone, but is the direct result of a powerful and persistent confluence of constrictive factors. Elevated mortgage rates, a holdover from the Federal Reserve's inflation-fighting measures, have severely eroded buyer purchasing power, pushing monthly payments to historic highs. Compounding this demand-side pressure is a chronic and severe undersupply of housing. New construction has failed to keep pace with population growth for decades, hampered by slow approval processes, high construction costs, and notoriously strict local zoning regulations that limit density. Consequently, the California housing market as it stands today is best described as expensive but critically undersupplied. Even with dampened demand due to high borrowing costs, the extreme scarcity of available homes for sale has created a floor under prices, preventing significant corrections. Sellers who secured ultra-low mortgages in previous years are disincentivized to list their properties, locking up inventory and creating a stickiness in pricing. This dynamic has resulted in a state of protracted stalemate, where transaction volumes are low and buying power for those entering the market is at a record low, defining the market's challenging trajectory into 2025. Housing market snapshot. The California housing market is fundamentally defined by a standoff between resilient, supply-constrained prices and demand hamstrung by the highest financing costs in a generation. This dynamic plays out differently across various property types, creating a complex and segmented landscape for both buyers and renters heading into 2025. Single-family homes, sticky prices, and geographic divergence. The market for single-family homes is characterized by profound stagnation in transaction volume, yet prices exhibit remarkable resilience. The primary culprit is mortgage rates persistently above 6%, which has drastically reduced the pool of qualified buyers and shattered the purchasing power of even well-earning households. Despite this suppressed demand, a historic lack of available inventory is preventing any significant price corrections. This is largely due to the golden handcuff effect, where existing homeowners feel locked into their ultra-low, sub-3% mortgages secured during the pandemic, disincentivizing them from listing their properties and sacrificing their favorable financing. This environment has catalyzed a clear geographic divergence in price performance. Coastal superstar metros like the San Francisco Bay Area and Los Angeles Orange County have seen prices stagnate or even decline slightly on an annual basis. These markets, which reached astronomical heights, are most sensitive to high interest rates and tech sector volatility. In stark contrast, more affordable inland regions, namely the Inland Empire, Sacramento, and the Central Valley, continue to post modest annual price gains of 2 to 3%. These areas are becoming the primary destination for intrastate migration, offering a relative value proposition for buyers and remote workers priced out of coastal urban centers. The key takeaway is a market frozen by high rates, where prices are too high for most to buy, but too locked in for most to sell, perpetuating the inventory crisis. Rentals and multifamily, cooling but supported by necessity. With nearly 45% of Californians being tenants, the rental market is a critical barometer of housing affordability. Rents remain exceptionally high, typically ranging from $2,000 for a one-bedroom apartment to $3,000 or more for larger units in major metros. However, after a period of explosive growth, annual rent inflation has cooled significantly to a more normalized rate of 2 to 3%. This moderation is a result of a wave of new multifamily construction deliveries, increasing supply, and a natural ceiling on what tenants can sustainably pay. Nevertheless, the fundamental driver of rental demand remains powerfully intact: the extreme affordability barrier to homeownership. For millions of Californians, renting is not a lifestyle choice, but an economic necessity, creating a steady, inelastic demand for apartments. This is why, even as growth cools, rents are not falling but simply rising at a slower pace. The active development in the multifamily sector is a direct response to this demand. However, this new construction is overwhelmingly concentrated in specific, high-yield urban areas and is nowhere near sufficient to close the state's colossal housing deficit. Estimates consistently place California's shortage of housing units at over 3 million, a deep-rooted supply gap built over decades that ensures the rental market will remain tight and competitively priced for the foreseeable future, solidifying it as a cornerstone of the state's housing equation. Commercial real estate divide. The California commercial real estate (CRE) landscape is experiencing a period of dramatic divergence, where traditional asset classes face severe headwinds while others thrive on powerful, long-term secular trends. This bifurcation is reshaping investment strategies and defining clear winners and losers in the state's post-pandemic economy. Office, a sector in structural reshaping. The office sector remains the most challenged segment of California CRE, grappling with a fundamental reassessment of space needs driven by the permanent adoption of hybrid and remote work models. San Francisco epitomizes this crisis, posting vacancy rates exceeding 30%, among the worst in the nation. The city's high concentration of tech firms, which were the quickest to adopt flexible work policies, coupled with high rents and quality of life concerns, has led to a perfect storm of downsizing, non-renewals, and a surge in sublease availability. This oversupply is creating downward pressure on rental rates and significantly devaluing assets, with some properties facing loan defaults. Los Angeles and San Diego present a slightly healthier picture, supported by more diverse economies encompassing entertainment, aerospace, defense, and biotech, which tend to favor more in-office presence. However, they are still pressured by the hybrid work trend, with vacancies elevated above pre-pandemic levels. The path forward for office assets is one of adaptation, requiring significant investment in renovations to create high-quality, amenity-rich Class A spaces that tenants desire, while older Class B and Class C buildings face an uncertain future potentially involving conversion to other uses or demolition. Industrial/logistics, the unwavering powerhouse. In direct contrast, the industrial and logistics sector continues to be a standout performer and a darling for investors. Its strength is fundamentally tied to the unrelenting growth of e-commerce and the need for robust supply chain infrastructure. California's unparalleled advantage is its proximity to the massive ports of Los Angeles and Long Beach, the primary gateways for U.S.-Asia trade. This ensures constant demand for warehouse, distribution, and last-mile fulfillment centers to expedite the movement of goods. The Inland Empire has solidified its position as the nation's logistics epicenter, boasting a vacancy rate below 4%, which is extraordinarily low by any measure. This demand keeps rental growth strong and fuels continuous development, though land and construction cost constraints persist. The sector's resilience underscores a critical California advantage. Its strategic role in global trade is difficult to replicate, insulating it from many economic downturns and cementing its status as a safe haven for commercial real estate capital. Specialized assets, high-growth niches fueled by innovation. Beyond traditional categories, specialized asset classes are emerging as high-growth niches driven by technological revolution. Data centers are experiencing explosive demand, particularly in Silicon Valley and its periphery. The exponential growth of artificial intelligence, AI, machine learning, cloud computing, and big data requires massive amounts of computing power and storage, making well-located data centers a critical and highly valuable infrastructure. Similarly, life sciences real estate in hubs like San Diego, South San Francisco, and Los Angeles is thriving. The biotech industry's need for specialized laboratory space with specific power, ventilation, and utility requirements creates a high barrier to entry market. Fueled by venture capital investment and continuous innovation in pharmaceuticals and medical technology, demand for these purpose-built facilities far outstrips supply, making them a highly sought-after asset class insulated from the trends affecting traditional office space. This specialization points to a future where CRE success is increasingly tied to housing the engines of the next economy. Regional winners and losers. The divergent trends across property types and sectors are creating a starkly varied real estate landscape across California's regions. Economic fundamentals, migration patterns, and sector-specific strengths are delineating clear winners and losers, reshaping the state's geographic hierarchy of real estate performance as it moves through 2024 and into 2025. Winners, affordability, and specialized economies lead the way. The regions poised for relative outperformance are those offering a combination of economic resilience, demographic inflow, and a compelling value proposition. Inland Empire and Sacramento. These inland hubs are the primary beneficiaries of California's intrastate migration. Priced-out households and businesses from the coastal metros are relocating to these areas in search of attainable home ownership and lower operational costs. The Inland Empire's economy is overwhelmingly powered by its dominant logistics and warehousing sector, which continues to see robust demand due to its irreplaceable proximity to the ports of LA and Long Beach. This provides a strong base of employment and investor interest in industrial assets. Similarly, Sacramento functions as a magnet for state government stability and a more affordable alternative for Bay Area refugees. This sustained in-migration supports steady housing demand, leading to consistent, if modest, price appreciation and solid multifamily fundamentals, making them standout markets in an otherwise stagnant state. San Diego. San Diego represents a unique success story, effectively straddling the line between coastal appeal and sustainable growth. Its economy is bolstered by a formidable and recession-resistant biotech and life sciences sector, which drives high-wage employment and demand for specialized commercial real estate. Unlike San Francisco, its economy is more diversified, with significant contributions from military installations, tourism, and international trade. This economic strength, combined with its world-renowned lifestyle and climate appeal, continues to attract a highly skilled workforce. The housing market, while expensive, has not reached the extreme stress points of the Bay Area or LA, allowing for more stable home price growth and steady rental rate increases, positioning it as a mature and reliable market. Losers, high costs, and structural shifts create headwinds. The regions facing the most significant challenges are those grappling with the most extreme costs and painful structural economic transitions. San Francisco. The Bay Area, and San Francisco in particular, faces the most complex set of adversities. It is the national epicenter of the hybrid work revolution, which has decimated demand for office space and created a downward spiral of declining property values, rising vacancy rates above 30%, and potential urban fiscal crises. This is compounded by well-documented challenges including high costs of living, homelessness, and public safety concerns, which have contributed to population loss. While its tech and venture capital ecosystem remains globally significant, the adjustment in its commercial real estate market is profound and ongoing, with a long road to recovery dependent on difficult conversions and adaptations. Los Angeles and Orange County. These markets are best described as stable but stretched to their absolute limit. Their diverse economies, spanning entertainment, trade, aerospace, and technology, provide a solid floor under demand. However, affordability is at a breaking point. The median home price requires an astronomical income, pushing the dream of ownership far beyond the reach of most residents and stifling demand. The markets are therefore characterized by stagnation rather than collapse. Prices are unlikely to plummet due to entrenched supply constraints, but have minimal room for growth, creating a state of paralysis. The rental markets remain tight, but are testing the upper limits of what tenants can bear, making them vulnerable to any economic downturn. Their stability is their greatest strength and their greatest weakness, preventing both a major crash and a meaningful recovery. Risks, opportunities, and 2025 scenarios. The trajectory of California's real estate market through the end of 2025 will be determined by the interplay of deep-seated structural challenges and powerful, forward-looking economic forces. Navigating this environment requires a clear-eyed view of both the inherent risks and the nascent opportunities, leading to a set of distinct potential outcomes. Risks, the persistent headwinds. the market faces several formidable risks that threaten its stability and growth. Climate shocks, including catastrophic wildfires, prolonged drought, and coastal flooding, present a constant and escalating threat. These events not only cause direct property damage, but also exacerbate the already crippling insurance crisis. Major insurers are retreating from the state, refusing to renew policies in high-risk areas, which dramatically increases costs for those who can secure coverage and potentially undermines property values and mortgage availability. Furthermore, the state's complex web of regulatory constraints, including the California Environmental Quality Act, (SEQA), and local zoning laws, continues to stifle new construction, perpetuating the housing supply deficit. Above all, the sticky affordability issue remains the most significant brake on the residential market, with high prices and elevated mortgage rates combining to create the worst housing affordability in the nation, a condition that leaves the market vulnerable to any economic downer. Opportunities, structural growth niches. Despite these risks, significant opportunities exist within specific market segments. The industrial and logistics sector remains a powerhouse, with its strategic importance to global supply chains ensuring sustained demand for warehouse and distribution space near major ports. The data center market, particularly in Silicon Valley, is experiencing a gold rush driven by the artificial intelligence (AI) revolution, which requires immense computational power and storage. Similarly, life sciences and biotech hubs in San Diego and the San Francisco Bay Area continue to attract massive venture capital investment, creating relentless demand for specialized laboratory and R&D space. Beyond these specialized assets, a clear opportunity lies in the development of rental housing in inland regions like the Inland Empire and Sacramento. These areas benefit from persistent in-migration driven by relative affordability, suggesting strong, long-term demand for both build-to-rent single-family homes and multifamily apartments to house the state's growing population. 2025 scenarios, 3 potential pathways. The convergence of these factors leads to 3 plausible scenarios for the California market in 2025. Base case, 60% probability flat to moderating growth. This most likely scenario assumes a higher for longer interest rate environment where the Federal Reserve cuts rates slowly and methodically. Mortgage rates settle in the low 6% range, insufficient to unleash pent-up demand, but enough to prevent a major downturn. The result is flat statewide home prices, with continued divergence between slightly appreciating inland markets and stagnant or slightly declining coastal ones. Rent growth remains steady at 2 to 3% annually, supported by high ownership barriers. The commercial market sees a continued divide. Industrial strength persists, while the office sector undergoes a slow, painful workout. Optimistic scenario, 20% probability, the modest rebound. This outlook is contingent on the Fed achieving a soft landing and executing faster, deeper rate cuts to combat a slowing economy. A swift decline in mortgage rates toward 5% would significantly boost buyer purchasing power, unlocking pent-up demand and leading to a modest housing rebound with 2 to 4% price appreciation statewide. Transaction volume would surge from its frozen state. Commercial investment sales would pick up steam across all sectors as financing costs ease, though the office sector would still lag. Pessimistic scenario, 20% probability persistent inflation and downturn. In this adverse outcome, inflation proves stickier than anticipated, forcing the Fed to hold rates high or even hike further. Mortgage rates could climb toward or above 7%, dealing a critical blow to buyer affordability. This would cause transaction volumes to plummet further and trigger price corrections of 5 to 7% in overvalued coastal metros. Ironically, this could accelerate rent growth as potential buyers are forced to remain in the rental market indefinitely, increasing competition for apartments. The higher cost of capital would trigger a deeper downturn in commercial values, especially for office assets, and could slow development in the industrial and multifamily sectors.